So, moving on to the next question, we recently discovered that he made a profit of 2.2 crores on a capital of 1.2 crores in the
Yeah.
last 1.5 years, and that was through microcap investing. So, could you share more light on that concept and offer advice for beginner investors?
Right, right. So, microcaps, like I said, right? So let me tell you what microcap investing is first, in very simple terms. You would have learned about VC funding, right? VCs are funding companies. Everyone knows that. Okay, VCs fund a startup. Now, startups can be listed also. You can have a company where the promoter actually directly went to capital market instead of going to a venture capitalist, right? So now venture capitalist access is limited to maybe tier one cities in India, Delhi, Mumbai, Bangalore, Calcutta, right? What happens to the other cities where people don't have a VC access, right? They go to capital markets, they go to stock exchange, and they directly sort of take capital from stock exchanges, right? So those companies are publicly traded. They're very small companies as well. 100 less than 200 crores, less than 300 crores, right? Very, very small companies. I would say they're effectively series A startups. I would say 90% startups in India are loss making, right? Most of them are actually loss making. They start by raising funding, burning money, and then they eventually become profitable. In the microcap space, in the listed companies, 90% are actually profit making. So if I go to stock exchange and buy a startup or buy a stake in a startup, they're all profit making companies, right? So now what I need to do is profit is guaranteed given that, okay, these are profit making companies. I need to find companies which are constantly increasing profits. So, and startups are not regulated by anyone. VCs will have VCs will check directly, right? There's no regulatory authority as such. However, in case of listed companies, SEBI is the authority. They will check that whatever startups are reporting, that is right or not, right? And SEBI does a really good job. I would say 98% companies report a very genuine set of numbers. Some, of course, frauds happen in stock market also, but 98% things are genuine, and 98% is a very big number, right? So you can trust the numbers which the companies are actually publishing. What I do is I always buy companies which are constantly increasing profits. Okay, which means what it means is that the customers, the company's products are accepted by the market, right? That is why they're able to increase profits. नहीं तो profit बढ़ेगा नहीं. So they should always increase profits. I think that is one thing which is there in my investment framework. Second thing is that you should always buy companies at good valuations. There's a ratio called price to earnings ratio, which tells you whether a company has a good valuation or not. Okay. So I typically prefer buying companies less than 30 price to earnings ratio. I don't buy above 30 price to earnings ratio. Typically, I can buy, but I prefer not buying. So that gives you valuation comfort. That if I even make an error, I'm buying a business at a cheap price, right? So like you buy potatoes, right? Potatoes have a fair price. Similarly, businesses also have a fair price. In case of potato, anyone knows that, okay, maybe 20 rupees a kg, 30 rupees a kg, that's a fair price because that is very experiential. We have seen potato market in our country, right? But businesses are not that intuitive for people. However, if someone learns investing properly, P ratio can actually tell you whether a business is overvalued, undervalued, fairly valued. I prefer buying undervalued businesses. Okay, so that's my second criteria. Third, I always prefer companies where I have some information available about the future of the company. For example, I recently purchased a company where my company has an order book of 500 crore, and that is publicly available data. However, people don't really go through this data. Very few people actually in India know this data. So you read this data, I actually have information advantage over anyone else. For example, you would not know that CATSys has a 500 crore order book, but I know that CATS half kya, matlab, maybe 99% India or 99.9% India doesn't even know CATSys is a company. I know that CATSys is a company available at a 9 PE and which has an order book of more than 500 crores. This data is very powerful data, which people don't even know, right? And there's a proper informational asymmetry there in the market. So if you have this information, you actually can use this information to make money, right? So this information I study from the stock exchange filings, NSE filings, BSE filings, which very few Indians actually do, and which is what Sovereign is all about as well, providing this data to people so that people start studying this, right? So that's the third aspect of future information, where I have either the order book of a company, or I know that my company has raised funding, or I know that the company has increased capacity, which I use in my investing as well. Fourth, HNI buying, like I said, right, I check whether other rich people are buying my company or not, and that gives me confidence as well. And lastly, I always like good sector companies. So after applying this framework, right, I typically have 20 companies in my portfolio. And of course, those companies, like I said, right, 75-80% do well. And that's how I was able to make this money from the market. Um, I would say the portfolio which you're talking about, right? That is a smaller portfolio of mine. I have another portfolio as well, which is a larger one. I would say my overall blended CAGR across portfolios is somewhere around 60 to 70% per annum. So 100 रुपए का मैं 160 170 कर रहा हूँ अभी every year almost for the last 4-5 years. So that's what I'm doing. That 2.2 or 1.2 is slightly more higher because that's a smaller portfolio. Of course, 3 crores is not a small number per se, but for me, for in terms of my portfolio, that's a smaller one, so the returns are very high. Otherwise, if you look at the blended return, the returns are not that high. It's somewhere around 70% CAGR, which is also fairly high, but not like 100, not like more than 100% returns. Yeah.